Deploying billions of dollars into a post-conflict sovereign state presents a unique set of structural risks. The capital is necessary for immediate survival, but without institutional guardrails, those funds can easily evaporate into inefficient systems or localized corruption. To mitigate this, international lenders coordinate their exposure. By early 2026, the European Commission had provided €3.5 billion, while the IMF's extended fund facility dispersed roughly $7.6 billion to stabilize Ukraine's macroeconomy. This timeline visualizes the most highly structured mechanism in play, the Rapid Recovery and Resilience Development Policy Financing, or DPF, program. Approved in November 2024, it outlines a $4.5 billion framework. The first tranche of $1.5 billion was released a month later in December, followed by a second $1.36 billion disbursement in September 2025. That brings us to the third and most highly anticipated release. On March 21, 2026, the International Development Association authorized the transfer of $1.64 billion directly to Ukraine's Ministry of Finance. This specific transfer represents a critical pivot in how multilateral institutions engineer sovereign recovery, using capital access to force measurable changes in governance. Traditional budget support often relies on a government's promise to implement reforms after receiving the money. The DPF reverses that timeline. This conceptual model illustrates the sequence of gated capital deployment. The $1.64 billion tranche is held in reserve, pending the alignment of specific policy benchmarks. Only when independent auditors verify that the required legislation has been enacted does the capital become authorized for release into the national treasury. By holding macro-level fiscal stabilization dependent on micro-level compliance, the World Bank explicitly links national survival to institutional change. This matrix outlines the requirements for accessing the third tranche. Ukraine had to execute 14 specific prior actions across 5 distinct governance pillars: procurement transparency, anti-corruption, judicial independence, energy governance, and social protection. The first requirement focused on state procurement. The government was required to mandate the electronic publication of all public contracts exceeding 5 million hryvnia. Next, the framework targeted the individuals managing those contracts. Lawmakers were required to enforce mandatory asset declarations for every procurement official in the country. Third, to ensure physical infrastructure projects weren't compromised, the state had to formally appoint independent monitors to construction oversight committees. This matrix operates on strict binary logic. If the government had completed 13 actions but stalled on the asset declarations, the entire $1.64 billion transfer would remain paused. This interlocking design prevents domestic politicians from passing popular social protections while ignoring politically difficult anti-corruption measures. Writing a law is one thing, proving it works is another. A resident World Bank team in Kyiv was tasked with verifying that these 14 policies were actually functioning in reality. This split-screen dashboard represents the direct audit of the state's digital architecture. To validate the procurement transparency requirement, auditors pulled logs directly from Ukraine's Prozoro system. The data trace confirmed that 98.4% of all eligible state contracts were successfully published and publicly visible. Verifying the human element required an audit of the newly mandated financial disclosures. The resident team confirmed that 14,200 public officials had successfully filed their complete asset declarations. Finally, they reviewed committee appointment records, verifying that independent monitors were actively stationed across 23 distinct infrastructure projects. These verified data streams feed into domestic enforcement agencies. The National Anti-Corruption Bureau uses these newly public disclosures to scrutinize the officials managing the funds. Once the World Bank team signed off on the empirical data for all 14 metrics, the Ministry of Finance was legally cleared to receive capital. This financial chart details the deployment of the $1.64 billion, dictating a strict division of the funds. The larger portion, $900 million, is allocated as national-level budget support, specifically for the state's energy grids and healthcare systems. The remaining $740 million is strictly ring-fenced for a hyper-localized infrastructure zone. This geospatial map tracks the parameters of this priority zone, stretching from the capital's northern suburbs down to the international airport gateway. The World Bank approved this specific corridor because the city administration has already completed technical readiness assessments for 14 distinct projects along the route. These include high-volume logistical arteries, like the Kyiv Ring Road Southern Bypass. It also funds the rehabilitation of the rail link to Boryspil, securing the primary aviation hub. At the residential level, it covers utility restoration in urban neighborhoods like the Podil district. Because the capital is now liquid and available, these specific projects can bypass typical funding delays and immediately launch their public tender processes. Isolating the $740 million to a pre-vetted geographic zone prevents funds from being diluted across regional projects that lack technical readiness to begin construction. The immediate physical reconstruction covers the domestic need, but the disbursement's primary macroeconomic function is the signal it sends to private markets. This flowchart demonstrates that dynamic. When the World Bank publicly confirms that the state has successfully implemented anti-corruption safeguards, institutional investors treat that validation as a proxy for acceptable governance risk. This sequence triggers secondary financing. Based on these reforms, the Multilateral Investment Guarantee Agency pre-approved up to $1.2 billion in political risk insurance. With the risk mitigated, private entities move in. 3 European construction groups, Strabag, POR, and Hochtief, have confirmed interest in bidding on €480 million worth of primary road contracts. On the private equity side, Horizon Capital closed a $120 million fund dedicated to reconstruction, citing the conditionality framework as a primary factor in de-risking the environment. The initial $1.64 billion transfer absorbs the foundational risk, allowing private institutional capital to flow into a post-conflict zone. This cycle is designed to repeat. The fourth and final tranche of the DPF program is currently projected at $960 million. Slated for late 2026, those funds are currently held in reserve, dependent on a new cycle of institutional requirements. To access those final funds, Ukraine will have to fully operationalize its oligarch register and hit specific case closure targets for its National Anti-Corruption Bureau. Sovereign economic recovery requires significant capital, but true stabilization relies on forcing the state to continuously re-engineer its own governance to access it.